How focused are you on further stimulus coming from the UK government? It's got to be the right thing at the right time, I suppose.
Yeah, I think what we've seen from the UK government has really been unprecedented, obviously, in its history, but also far exceeding what we've seen from other international peers. And I think what's interesting is how they're actually funding that deficit. So we've seen immediately that the fiscal deficit has increased. And we've seen the Bank of England really kind of step up to almost buy all that increased issuance, which is why we've seen the UK gilt market. I know it kind of sold off very sharply in March on the initial announcement of all this fiscal spending, but it's really rallied and performed quite strongly. So to me, any kind of further increase in fiscal stimulus kind of implies an increase in Bank of England quantitative easing in order to facilitate that increased debt issuance. And we think that will be a major driver of sterling going forward and really suggest, along with increased political risk, that sterling should fall.
So you see, relative quantitative easing set to be one of the factors that weighs on the pound. You also see the Brexit negotiations. Of course, we can talk about that in a moment. But just wanted to remind ourselves, you point out that 80% of the UK economy, just over, is services. And if it proves very difficult to reopen services activity post the lockdown, that could be something that relatively hits the pound harder than, say, the euro or other currencies.
Yeah, absolutely. I think the very clear story from, if you look at global PMIs, is that services sector has really kind of taken the brunt of coronavirus and of lockdown measures. So considering, that massive weight that the UK economy is disproportionately focused in on the services sector really suggests that actually the UK is kind of most exposed because of its economic makeup, which is, probably one of the reasons why the UK government has kind of stepped in with all the support. But it does suggest that we'll see a lagged recovery here in the UK from the coronavirus.
And we do expect Brexit talks to resume once again this week, Eimear. There is a deadline looming at the end of June, the end of this month, let's remind ourselves. But I wonder how much that matters, given we've heard very strong words from the UK government that they will not extend. Is the base case for markets now that there'll be no extension, and so the deadline that matters is into the autumn and December 31st?
Yeah, I think you're right. I think, policymakers have have been very, very clear that they are not going to ask for an extension. Even we had some comments from David Frost last week suggesting, that a tentative deadline for a fisheries agreement, was likely to be missed. So actually that kind of crunch point that we were expecting at the end of June is now unlikely. But we do think as we kind of push past that deadline, we don't have an extension, and heading into year end, we will see kind of increased rhetoric and increased kind of focus on the Brexit story. I think looking at the FX complex, kind of Brexit is, this kind of clear idiosyncratic risk. And I think in a world where everyone is kind of looking at global PMIs and coronavirus confirmed case curves, the markets could really zone in on this as kind of having a stronger narrative and a stronger direction.
And Eimear, what do you make of the strong risk-on picture that we look set to inherit here in Europe from Asia overnight? Clearly, Hong Kong and the Hang Seng moves higher based on relations between the US and China. That's kind of its own story. But the rally in Asia was broader than that. The rally into Europe looks as if it could be very strong, but US futures really quite subdued. What do you read into that kind of risk-on picture that we expect for Europe?
Yeah, I think it will be a risk-positive session for Europe today. I think there was a lot of kind of nervousness heading into Trump's speech on Friday, and really it kind of didn't deliver the kind of bite that markets were expecting. There was loads of expectations that you could get, the next US-China trade war, you could see, broad financial sanctions, and none of that really materialized. I think what we actually got was sanctions or retaliatory measures that were very focused actually on Hong Kong, and with only a few kind of remediation issues for China, such as visa restrictions. So it kind of lacked bite. Saying that, though, I wouldn't kind of buy into a NIMBY rally. I think what was very clear from the speech was that, this is almost a presidential campaign speech, and this kind of strong stance on China is something that we're very likely to see continue right up until that election. And we think in that environment, I wouldn't get long the renminbi right now.